Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks Rocks and passionate investor. Welcome to my YouTube channel. This week we are reviewing Canadian banks' quarterly earnings. So after reviewing Scotiabank and BMO on Tuesday, and then Royal Bank and National Bank on Wednesday, we finished the week this Friday morning. Probably by the time that you see it, actually it's going to be Friday afternoon, but whatever. Today we're talking about TD and CIBC, but first, let's take a look at how banks did this week. Kind of funny because it was not necessarily a good week for investors in general. Markets were going down, but all Canadian banks surprised the market. National Bank led the way on Friday morning, up almost 9% for the week. Then followed by Scotiabank and TD at +6, and then you have Bank of Montreal and CIBC at +3, and our little laggard, Royal Bank at +1%. Still making money on all of those, and this is mostly because they had great earnings. And now let's take a look at CIBC and see what happened there. When you look at the dividend triangle, you will see that CIBC has been lagging in terms of earnings. So revenue is growing for the past 5 years. Pretty much hit a plateau in 2020 for the pandemic. That makes sense. But then you look at EPS, nothing happened between 2017 and 2020 before the pandemic. This is a bit disappointing, obviously, and this is one of the reasons why CIBC is offering a high yield and trades at a low PE ratio. It's lack of growth. Then again, good dividend payment, no dividend increase on this quarter because all dividend increase are being frozen by regulators. Hopefully, it's going to, with all those great results, it's going to be changed in the future. But in the meantime, dividends are safe. You don't have to worry about anything. Now, for the quarterly earnings for CIBC, we can see here earnings per share went up by 10%, which is very good, and then revenue were up by 2%. You're going to see pretty much the same story in this review. We're going to talk about high trading volume, good wealth management performances, higher deposits, higher loan book. Unfortunately, earnings will be squeezed a little bit by interest margin getting lower, and at the same time provision for credit losses decrease. There you go, earnings jump by 10%. CET ratio at 12.3, so pretty much on the average that what we have seen so far. The weakest one among the 6 banks was National Bank at 11.9. All the others were between 12 and 12.5 so far. So CIBC is not better, not worse, pretty much average in that term. Moving on to Canadian personal and business banking. CIBC had a good performance. Loan portfolio is up by 4%, and then double-digit growth for deposits. So we can see that a lot of people are saving money. Obviously, government aids helps a lot to boost deposits these days because they're receiving a lot of money. And then same story here. We have interest margin squeeze. So you can see that on the red squared on that graph, going from 242 to 228. So the net interest margin is getting lower. We will have to deal with that for a few quarters, possibly maybe a couple of years. So get used to it. And what you see is the bank needs double-digit growth for their loan portfolio and deposits to generate a few percent of return, a few percent growth in terms of revenue. So don't expect too much from this specific segment in 2021. It's still going to be rough for all banks. The commercial section looks a lot like personal banking. So you see loans up 2%, deposits up 26%. So in other words, businesses are doing well. And what obviously drove earnings here is the sales of mutual funds. Kind of funny because we're always thinking, oh, everybody is investing in ETF, robo-advisor, or they do business with DSR and they manage their own dividend portfolio. But unfortunately, for some investors, they still go with high fees mutual funds sold by banks. At one point, There's not only the interest rate that you have to consider here, there's also the quality of advice. So if you have a good financial planner that takes care of your things and that see things up front for you, maybe it's worth it to pay 1.5% fees to get your stuff managed by a professional. You know what? Sometimes you're better off with professionals than trying to do everything by yourself if you're not willing to invest the time and the knowledge to manage your own portfolio. Then we have the same story for the US side of commercial banking and wealth. Then again, double-digit growth performance for both loan portfolio and deposits, which is quite impressive for the US part. And assets under management is increasing. The fees are up 16%. Obviously, when the market goes well, investors are more tempted to put money inside the market, and there you go. Assets under management increase, fees increase as well, and then the bank is happy. In the capital market, again, we see the same story as other banks. So this video is a little bit quicker because we've seen those major drivers over the past couple of days. Now I'm just like pretty much repeating the same thing for CIBC. Here, net income surged by 30%. Main drivers are lots of trading, lots of fixed income, foreign exchange, and equities. A lot of direct investors, so we can see how clients are now opening their own brokerage services and they want to trade on their own. Is it a good thing? Well, I think it's a good thing as long as you know what you do. Well, looks like a lot of investors are decided to take control over their finance. So kudos to you if you're part of that gang. I think that we're going to do a good job together. Now, here's something a little bit different that we haven't seen in other banks' earnings. It's the provision for credit losses. This time, it's not back to Q1 2020 level. It is actually a lot lower. So basically, CIBC is telling us, you know what? Our loan portfolio is doing so well that we have to decrease our provision for credit loss by a wide margin, and we are fairly confident that pretty much everybody is going to pay their loans. So it's good news, but I would still be a little bit more cautious about that. We have 4 banks saying we're going back to pre-pandemic level, and then you have CIBC saying, oh, no, it's not back pre-pandemic, it's actually better than what we used to have. And that kind of surprised me. I mean, I guess it's good news. I'm going to trust them. They know their loan portfolio a little bit better than I do, but just keep a track on that for the future quarters. When we look at the COVID impacted businesses, we haven't seen something that is as clear as other banks. CIBC is giving us the loan portfolio as a whole, and then it tells you that they have 3% in cards, 1% in auto lending, 4% in personal lending, 1% in retailer, 2% in oil and gas, and 1% in leisure and entertainment. So it's not exactly identified where the COVID could hit or not. I was a bit disappointed for that. I wanted to compare with other banks. They were saying like between 4.5%, 5%, 3.5% for National Bank. But this one is a little bit more blurry. We don't know exactly. I guess they have a pretty strong loan portfolio based on their provision for credit losses. And let's finish CIBC review with their digital engagement and adoption. You probably know by now, in my past 2 videos, I was tracking that as well for you. Bank needs to move quick, and CIBC is doing a great job here. We're having 75% adoption rate, which is the highest rate so far that we have seen. Usually it goes between 45 to 55% for other banks, and CIBC is definitely a champion in that category. So kudos to them. Mind you, they're more focused on savings and loans. So I guess that it's really important for them and for their business to have their clients to do some of their banking online. Now, TD Bank, my third favorite bank. I still prefer Royal Bank and National Bank, but TD is doing very well. You've seen here the revenue trend is up like almost perfectly. And then what's interesting is for the earnings per share, you still have a jump, a good rebound in 2020, but that came with the sales of TD Ameritrade to Schwab's. This obviously bump up the earnings a little bit. And then again, we have the dividend growing steadily, and then likely to have a dividend increase pause for 2021. Overall, yet another very strong quarter for TD. Earnings is up double digit by 10%, but what I want to show you here is quite impressive. It's their common equity tier ratio, the CET1 ratio that we look for all banks. Remember, everything over 10% is good. Most banks are around 12, national banks at 11.9, and the others are between 12 to 12.5. And then you have TD in another class at 13.6. I keep saying that Canadian banks are well capitalized, but then you have an example that it cannot be better than that for a bank. So TD is definitely king in that category. If I have to show you three graphs today about TD Bank, that would be those one. Canadian US retail net interest margin going lower and lower. This one, they used to have a very good margin at 3% last year. Now we're down at 265 and 224. So a bit disappointed, obviously. And the other thing that we see here is Canadian retail wealth. Big jump in terms of transaction. Not a surprise. We've been seeing this narrative for the other banks before, but this one is a little bit bigger than the others. In Q4, we talked about 210 million, and now we're at 306, so that's a huge jump. Let's see if this trend will continue in 2021 or if it's just like a one deal thing. So far, I think we're going to have an increase of independent investors, but not necessarily to that level throughout the entire year. It goes by wave, and it's not everybody that could manage your portfolio. So some of them will give it a try. They probably feel nervous, and then they will go back to robo-advisors or ETFs, hopefully, or even mutual funds. For Canadian retail, we have loan volume up 4%, deposit volume up 21%, so great performance here. But because of interest rates are lower, revenue were only up by 1%. This is giving you an idea how strong you need your portfolio and deposits to grow just to generate a little bit of revenue. So keep that in mind for future quarter. The highlight here is the drop of provision for credit losses by 43%. This is huge. Then again, it's kind of surprising because all the other four banks were saying, yeah, we're back pandemic level, like pre-pandemic level, and then CIBC and TD, they're just saying, you know what, we have like the best loan portfolio in town, trust us, and we will not suffer from default loans here. So it's a good news. We'll see how it goes going forward. I still have to put an asterisk on TD's quarter as well. Just not convinced it's going to keep up at that level for the next 3 quarters. US retail, we have revenue down 5%, loan volume is up, but obviously the transaction with Schwab kind of like mixed the whole thing here. Also, I want to highlight here, provision for credit loss down 76%. It is also big numbers there. Not too sure what's going to happen next. This is also probably in line with the Schwab transaction, so we're going to have a better idea in the upcoming quarters, but overall, US retail did very well. Wholesale banking, which is usually called capital markets or global markets by other banks, net income up 56%. They just like knocked one out of the park. Expense were up 9%. Obviously, if your people are performing, you have to pay them a little bit more. So that's good. High trading is also responsible for a good part of the revenue growth for TD. US retail, wealth, and Schwab. This segment is obviously supported by strong growth from retail investors trading. So trading volume were up. We're talking now about adjusted net income of 68% increase, which is incredibly high. Keep in mind that with the transaction with TD Ameritrade, now TD has 13.5% of Schwab's total assets, not total assets, but total shares. So whenever there's good news on the trading side and then investors are confident and invest in the stock market, well, TD will benefit from that from their US segment. Now let's take a look at their provision for credit losses. Again, very surprising because now they're telling us that it has been the best provision for credit loss in terms of percentage in the past 15 years. It's been explained by two factors. First one, strong government support, and the second one is strong performance from their performing loans. So they expected to have a few ones to go down and go into default, and it didn't happen. It's good news. Then again, I'll repeat myself, but I'm not too sure I want to believe in that narrative too much and then get like super hype around it. I will remain cautious about TD Bank. It's still a very good bank. They know what they do and they know they're banking well. I mean, they just seem so optimistic for the future compared to the other banks. It kind of like a big difference here from other tone that was like a little bit more moderate. This was like, oh, it's good, but not that good. This time it's just like, wow, it's amazing. So let's see how it goes for the next quarter. Finally, it's kind of interesting because we have 6% of their loans affected by COVID, which is the highest level across the 6 bank. So they're the most exposed to COVID according to this graph. And at the same time, they're telling you, you know what, don't worry about our loan portfolio. It's super solid. So maybe we're going to see a lag that like some people or some businesses are trying to pay their bills and then benefit from government support. But when all this stops, maybe during summertime or next fall, it will be interesting to see how the loan portfolio development will happen. So in the meantime, enjoy your dividend, enjoy your investment on TD. The market was super pleased about the stock market, about their performance. And also just want to finish on that note. I think that they're also doing a very good performance with digital adoption. Remember, the other banks were between 45 and 55. Then we have CIBC at 75%. Maybe there's something wrong with their calculation or something. And then we have TD at 60% for Canadian, 49 for US. So well above the average, behind CIBC, but then like there's the two top leading. It seems like it's interesting. They report their earnings at the same time and they were quite similar versus the other banks. But overall, it was an amazing quarter for all Canadian banks. The signal it tells us is that the Canadian economy is stronger than expected, more resilient, and obviously the fact that resources are bouncing back. The oil barrel is now at its pre-pandemic level. It's going to support a big chunk of the Canadian economy that we might have thought would have gone sideways in 2021. So overall, I think those are very good news for the rest of the year. Obviously, always think that the market is always ahead of economic numbers. So now the banks are telling us the economy is going to go well, it's going to go better, and the market already priced that. So don't be surprised if the next unemployment rate, even if it's better than we thought, maybe the market won't move that much because it's most of the rebound, the recovery from COVID-19 is being priced in the market at this time. So high expectation for the rest of the year. Make sure that you remain very strict when you select your stocks. Try to like increase a little bit more the numbers that you're following, be a little bit more difficult with them to make sure that you select only the best stocks for each sector. Same thing with the banks. If you hold like 4, 5, or 6 banks, maybe it's a bit too much. It's like a little bit too much different type of salts in your soup. At one point, you're not getting a better soup, you're just getting a saltier soup. So think about that. And next week, I'm taking off for spring break. I'm gonna relax, so no more videos. I'll be back on the second week of March with something else. So until the next video, stay invested.